Today's market action is a very good example of why the candlestick investor has a great benefit of knowing where to put their stops based upon investor sentiment. After the big selling yesterday, notice what it did. The Dow moved out of this sideways trading range that had been established for the last 3 or 4 weeks. After a quarter-point rate cut, apparently the market didn't like it and sold off. However, today it traded right back up, gotten back up most of the selling, and probably would have stayed in that mode until the tariff tweak came out and they crunched the market. Now remember, prices move based upon investor sentiment. When the sentiment had already turned doubtful or bearish and then seemed to be recovering, another piece of negative news had probably much more effect heading for the downside. So it was much easier for them to everybody start bailing again because the investor sentiment had turned sour the previous day. Had that same tweak today been over in this range, probably the results of the selling would not have been as big. And as illustrated in the NASDAQ, that opened higher and actually traded above the open of the previous day. That showed a lot of strength coming back until the tweak. So it's very simple. The mechanics of putting in a stop loss is very simple. If you started seeing it sell off, if you were in trade situations, very simply put your stop back at where it opened, because as logic says, if it comes back down through there, your green candle is now turning red, telling you the sellers are in control. You want to be stopped out. And today is a much greater illustration of why the patterns will work much more beneficially, especially when you have a surprise market turn. You can see kind of the big fry pan bottom in MyGen. And then you can see how the T-line was pushing the uptrend back up into the resistance level. The resistance level not only being the 200-day moving average, but approximately the same level as where this big fry pan bottom started. Where was the likely target? To at least come up to the 200-day moving average. And the benefit of candlestick analysis is that you're establishing positions that have high probability results. Buying or owning this fry pan bottom with the expectation your target was the 200-day moving average is a type of setup that allows the candlestick investor to be participating in a trend movement or a pattern movement that can produce these big, huge gains because it puts you in the right place at the right time. The same scenario can be applied to any of the recommendations that are based upon a pattern. As you can see in GOL, notice what it did today. The market was down big, but the fry pan bottom was still working with still the potential of a breakout going into wave 3. The benefit of a candlestick pattern is that it is the identification of investor sentiment buildup that's probably not going to change on a one-day situation. That'll be it. We'll see you in the chat rooms.